what are your views on the fact that the market really seems to be focusing in on that slowdown in imports in China, sitting with this growth there of 7% year on year?
The import numbers are a problem because the Chinese keep on telling us they want to diversify their economy, they want to move it more towards a consumption-led model. And yet if you look at numbers like car sales, 12-month passenger vehicle sales in China have been flat at about 19 million for the last 12 months. We've seen no growth at all. And we're seeing that in a number of different areas in China. So what's evidently important is the export story. And our exports going to start picking up, and perhaps that will then lift Chinese import demand for commodities. Exports were weak this month. That was already flagged in export orders data that we saw in the PMI a few months ago. But more recent PMI figures tell us that exports are going to pick up quite sharply. Stronger numbers in April, stronger numbers in May, and that then should lift imports. And I think the markets will be feeling a bit more comfortable next month when we get the next release.
So the market is, of course, very reactive to the daily news flow that we see coming out. But from your perspective, this is a temporary blip, and you could be looking at a situation where you're starting exports grow at double digits once again. Would that be a fair view?
Yeah, no, we think so. We think maybe 20% growth we might be seeing in April and May. But the markets are right to be focusing on two other issues. And one is that the US, which everyone's been getting much more optimistic about in the next few months, isn't going to be a fantastic story. It's probably not going to be weak enough to justify QE3, but not strong enough to be hugely excited by. And what's happening in Spain in the last week or so tells us that the Eurozone worries could yet come back and hit us hard later this year. So those two figures and uncertainty about China's ability to boost domestic demand, these are all three issues that the markets are right to be concerned about.
And as you say, the US economy, in terms of it being a key trading partner for China, is important to note, because looking at exports to the economy, they were up by 10.4% year on year in this period. Let's focus in on those jobs numbers and your views on the jobs picture overall in the US right now. What are your views on the concerns that there might have been a false dawn in that jobs market? Are we going to start seeing worse numbers coming through as we move into the rest of the year?
Our base case is unchanged since the middle of last year, which is that we would end 2012 at around 7.5%, 7.75% unemployment rate. But that wouldn't come from jobs growth. It would come from people giving up that they will ever get another job in the States. And all those people who were making homes in Florida or California 3 or 4 years ago, they're probably right to be giving up, because this growth, yes, there's been a bottoming of the housing market, but the growth isn't about to come back. And these people are not the ones, they don't have the qualifications to go and get the jobs in the growth areas. Apple stock is the best example of the growth area in the States at the moment. But to get a high-tech job versus a construction job, these two aren't the same thing. So as people give up on looking for jobs, the unemployment rate comes down, but it doesn't mean that you get fantastic jobs growth. But it does mean that the unemployment rate should continue to decline gradually through the course of this year. You mentioned the likelihood of quantitative easing, and it seems that the market are a bit confused right now as to whether we are going to see further quantitative easing coming through from the States. But in your view, what needs to take place for the Federal Reserve to actually put that back on the table again? Well, I'd use the number 2. If we had 2 months of rising unemployment rate, if we had less than 2% growth, and if US 10-year treasuries get much above 2%, then I think the Fed will be keen to consider QE3. But today we do have bond yields still at 2. Growth in the fourth quarter last year anyway was 3%, and unemployment rate keeps on falling. So I don't think QE3 is on the agenda now, and that did come out through on the minutes of the last Fed meeting. Yeah, it can't be ruled out, but we haven't got the data yet to prove that it's necessary.
Let's focus back on China. Before I let you go, basically what we're trying to ascertain right now is, are we heading to a situation where we could have a hard landing in China? Is the risk of that hard landing becoming more prominent, and does the Bank of China have the financial muscle to be able to manage the economy if we do start seeing a big problem panning out in Europe and the United States?
The reserve requirement is still over 20%. There is huge scope for China to ease policy if they truly worried about a hard landing. There are signs that domestic demand is weak and that exports have obviously been weakening too. But if exports pick up, if the government efforts to boost consumption, if they don't deliver, then we would be expecting quite a lot in the way of cuts from China. And the banks do have enough cash in the system to be able to lend out. Does that create an inflation risk? Yes, it does. Are the Chinese very cautious about it? Yes, they are, which is why we haven't seen it already. But if there was a hard landing threat and you were worrying about unemployment jumping up, then I think the Chinese would be acting.